Hello and welcome to Rupeeting's YouTube channel. I am Sagar Lele, the founder of Rupeeting. And we're here to introduce a new segment to you, which is decoding the stock markets, primarily around major economic events. A good start is the union budget for FY26, which was recently announced. A lot of people would have broken it down for you in terms of what was announced and what the likely impact of that is. But we're here to talk specifically about how the markets are going to react to this budget. So everything we do is from a very investment heavy standpoint. So we'll be looking at the budget from the market reaction, in terms of market reaction, in terms of what sectors to play out, and possible strategies to navigate however the budget turns the market. So to start with, I think the budget looks very underwhelming from the perspective of a lot of investors and experts. And this is especially because how the government has been functioning for the last decade. So we're all very accustomed to blockbuster budgets which go very aggressive on spending, particularly on infrastructure related capital expenditure. However, in that context, if you look at this budget, it was completely missing in terms of any mention on capex. In fact, the FM entirely skipped the capex number for FY26, which was quite a surprise. We all thought that the number is going to be so dismal that they had to entirely push it out of the budget speech. And the emphasis instead went on to the personal income tax relief for the middle class. Which is great from the narrative standpoint. However, turned out to be disappointing for a lot of investors because it just lacked enough growth measures for the economy. And that was the quick inference that a lot of people drew out, right? Especially in the context of the welfare spending that the government has been doing over the last year, especially after its diluted victory. However, we think differently about this budget. We think there's enough going on to support the revival of growth, and it's being done in a very balanced manner. They're not only focusing on capex but also on boosting consumption, which is new for the markets and hence probably diluted, but we still think it's very growth oriented. The second aspect we want to highlight in this entire video is the fact that um, so far, the onus of spurring growth has been on fiscal policy over the last 5 years. However, that has been because of the context of the underlying economy and how interest rates were moving and how monetary policy was moving. However, this time it's a little different. We think the onus of spurring the growth in the economy is not only on fiscal policy, but is also going to be supported by other factors, including monetary policy. So, if you look at the overall context, and look at how this budget is fitting into that context, we think overall it's a positive for the markets. The way things are moving on all of these fronts, we think that the economy may be bottoming out, and it may be turning a corner at this point in time. So we are positive from how things are moving. Earlier, we had a very divergent view. We were long-term positive on India, but we saw a lot of headwinds in the near term in terms of growth as well in terms of corporate earnings and in terms of valuations. But the way things have moved over the last 3 4 months, and the announcements both on a fiscal and monetary side make us change this view at this point in time. So, coming back to the budget, we think it's done right on three fronts. Number one, we still think there is growth orientation in this budget. Now, we're all accustomed to that capex number as we highlighted. However, the FM speech was surprising on two fronts. Right. Number one, the capital expenditure number for FY25 was revised to 10.18 lakh crore. If you remember, the last budget had set a number for 11.11 lakh crore. So the revision of estimate is actually saying that the government is in FY25 going to spend lesser than what they had earlier envisaged or budgeted for. And this reduction is of about 8%. So to put this into perspective, last year we would have expected capex to grow by 11%. However, in FY25, it'll actually end up growing at about 7%. And this comes in the backdrop of us having seen a capex growth of between 20 and 30% over the last, in each of the last 3 years before that. So that's a dramatic reduction, not only in the budgeted allocation, but also in terms of what the execution has been, which has been extremely poor thanks to the elections. So that was surprise one. Surprise two was that FY26 numbers weren't even announced. So the immediate reaction was that, hey, the number is going to be so bad that it had to be completely left out of the speech. However, the fine print came in, and the capex outlay for FY26 came in at 11.21 lakh crore. Now, this on a revised estimate for FY25 fits in at a 10% growth. Um, Agreed that it is lower compared to 11% last year and 20 to 30% in the 3 years before that. However, I think the way you should be looking at it is that any number which is higher than the estimated GDP growth is a boost. Right. So from that logical perspective, we're coming to the fact that the estimated GDP growth is about 6.3 to 6.8%. In front of that, if the infrastructure spending, sorry, the capex spending is going to be at 10%, it's still faster than what your projected GDP is, and hence it's a growth. So overall, I think the lack of growth orientation is falsehood. There is growth present or accommodated for in the budget. The second growth factor that is in the budget is clear from the shift from capex to consumption. Um, the budget's focus clearly was on the relaxation of income tax for the middle class. With the proposition of no tax for an annual income of rupees 12 lakh is a great narrative. However, I think what you should be looking at is also the fact that the revenue foregone for the government is at 1 lakh crore because of this. Essentially, what we're saying here is that the government would have earned 1 lakh crore rupees because of these taxes. However, the concessions or rebates or whatever you want to say um, put the 1 lakh crore in the hands of people. So, from a very centralized spend on capex, this is becoming a decentralized uh, liquidity boost in the economy in the hands of people for them to consume, right? So if we look at the past budgets, whenever this 20-30% growth was announced in terms of capital outlay, if I look at FY22, the amount of capital outlay over the last year in absolute terms was about 1.82 lakh crore. FY23 about 1.48 lakh crore. Between 2 to 2.5 lakh crore for FY24 as well, right? So we're seeing a number between 1.5 to 2.5 lakh crore. Suddenly, FY25, because of poor execution and the lower budgeted capex, you saw a absolute addition of about 70,000 crores, right? So dismal in front of what was in the past, and that is reflected in the economic growth at this point in time. You see how the GDP growth has suddenly dropped off, and a lot of it can be contributed to the fact that suddenly fiscal spending has dried up. However, if you look at this budget, right, you've seen a 10% growth in the capital outlay. If you have to convert this into an absolute number, it comes to about 1 lakh crore. Additionally, if you look at the 1 lakh crore that has been passed on to consumers or citizens in order to consume, that comes to about 2 lakh crore. Now, this quantum as a number for pushing growth is pretty consistent with what we've seen in the 3 years before the last year. So, from that perspective, we think that the budget has taken a very balanced approach in order to achieve similar results as the past. Agreed, a little lower, but still quantum wise, pretty much out there. The other thing that may come as a criticism is that infrastructure spending is more healthy. It has a multiplier effect. That's because every rupee spent will lead to more jobs and hence more income, more consumption, etc. However, when you put money into the hands of people directly, there is a consumption spur, and that's not as healthy as or as multiplicative in effect as infra spend. In any case, we think that this was the need of the hour. Consumption has been extremely weak for the Indian economy for the last 4 years, despite the good growth numbers that we've seen. So GDP has grown, the markets have grown, but the one consistent narrative has been that consumption is weak. So from that perspective, I think the government's strategy of dividing growth catalysts across capital expenditure as well as consumption while maintaining the quantum of growth or slightly lower, is great for the economy. The third positive thing that this budget does is that the focus on growth comes hand in hand with a focus on fiscal prudence. Now, every government, every budget, if they want to spend money, they need to get the money from somewhere, right? Typically, any aggressive or growth-oriented budget will spend more than the revenue that the economy has, and that's what's happening in India. The part between the two, which is the gap between the expense and the revenue, is called the fiscal deficit in the most simplistic terms. Now, for any government to maintain a healthy balance sheet or a healthy way of functioning, what they need to do is that they need to maintain the gap between these two at a healthy level. Post COVID, of course, things went haywire, and in order to boost the economy, the government was going aggressive, and we'd seen a fiscal deficit of about 6.7% in FY22. From there, consistently up until now, the government has ramped down on the fiscal deficit, which is a very healthy way of spurring the economy. So from 6.7%, you came to about 6.4% in FY23, 5.8% in FY24. And the revised estimate for FY25 stands at 4.8%. So that's a big move in terms of fiscal prudence. And for the next year, this budget announced that we'll be touching about 4.4%. So 10% growth in capex, 1 lakh crore in the hands of consumers. At the same time, maintaining fiscal deficit at 4.4% and on its way downward. Great move. Coming to part two of the video, we think the budget also needs to be looked at in the context of the entire economy. From a policy standpoint, there are two things available for any economy: there is the fiscal policy and there is a monetary policy. However, let's try to understand what happened in the last 5 years post COVID. Post COVID, the entire world had been grappling with very high inflation, which actually led to a place where most central banks saw the steepest and quickest interest rate hike we had ever seen. That is actually a monetary policy which is contractionary, right? Um, to negate the effect of this contractionary monetary policy, India specifically had a fiscal policy which was very aggressive. We saw capex spend increase more than 2x between 2020 and 2024. This successfully led India to a place where we were highest in terms of growth at a global level. And hence, India became the preferred destination for investments globally. And this also offset the impact of the regressive monetary policy that we'd seen. If you look at FY23, that was the year when RBI increased rates by about 250 basis points. That's just within 1 year, right? If you look at how the expectations for RBI's policy are setting up now, we are actually getting very pleased with even a 25 or 50 basis point rate cut. Compare that with the 250 basis point rate hike within 1 year, and still India's economy was pretty much unaffected thanks to fiscal policy. So, from a lot of the investors' perspective who are maybe new in the markets or who are accustomed to how things have been functioning over the last 5 years, um, growth equals responsibility of the fiscal policy. And that's right from your perspective because new to the markets. However, I think we're at a very different stage at this point in time. There are a lot of measures by the RBI over the last few months which have been actually very growth inducive. Look at number one, the 50 basis point CRR cut. This itself is expected to bring about 1.2 lakh crore into the banking system. Number two was a host of measures recently announced in the form of bond purchases, repo rate auctions, INR USD swaps. Together, these are expected to inject 1.5 lakh crore into the economy. On top of this, RBI's policy meeting is next week, and that's where consensus estimates at this point in time are towards a rate cut. Whether it is 25 bips or 50 bips, both of them, either of them, are expected to spur the economy because of liquidity. So, at this point in time, the fiscal policy needs to be looked at in context with what's happening versus a very contractionary and regressive monetary policy which was over the last 5 years. So, in that context, has the budget done enough? We think yes. So, coming to the main bit, how does this affect the markets? We think that as a combination, the fiscal and monetary policy together bode well for the economy. However, the kind of growth you had seen over the last 5 years versus what you will see now would be slightly different because of a change in the focus area and change of growth drivers. Earlier, the play was very obvious. Whatever the government spent on was a clear buy from an investment perspective. So everybody went gung ho on infrastructure, defense, power, railways, all of that. However, this time we need to look at it differently. One, capex plays need to be reduced a little bit, and we can see that in the capital outlay numbers. So if you look at the capex for railways, flat. If you look at the capex for roads and bridges, flat. Defense up 12.5%. So that's a continuing positive. The other two continuing positives are metro spend is budgeted to be up 23% in the next year. Spend on renewables is high and intact as well. So three plays when it comes to capex orientation. But the other larger play that we're talking about is the shift towards consumption. Not only because of budget, but also because of monetary policy. So we see a lot of positives for the consumption sector, and that has been reflected in how the markets reacted on the budget day as well. The consumer indices were up about 3% in a otherwise flat market. The exemption limit hike to rupees 12 lakh, the income tax benefits, specifically directly impact three sectors in our opinion. One is automobiles, number two, consumption, especially discretionary, and number three is the banking sector. So the change in direct tax can reduce consumer leverage and improve asset quality in some of the stressed parts of the banking system. So three direct plays there. Other than that, the budget had some specific announcements which would bode well for sectors like affordable housing in the special window for Swami Fund, chemicals because of the revival of three urea plants, some amount of geospatial because of the focus on mapping and urban planning, um, healthcare because of PLI promotion for formulations and bulk drugs, promotion of medical tourism, insurance because of an FDI limit hike from 74% to 100%, and tourism because of a boost in tourism, development of tourism infra, um, etc. So it's pretty clear that how the markets are going to function in 2025 is going to be very different compared to what was in the last 3 to 5 years. The last 3 4 months have given us a good glimpse of how different it can be. And we think near term pressures and the recent dip do provide an opportunity, and the markets can potentially stabilize here. However, the strategy for playing the markets has to be very different. It's not going to be a pick anything and win market. I think it's going to be more of a stock pickers market where you'll have to be very specific in terms of which stocks you're playing, what sectors you're playing, and whether that will make returns or not. The uniformity we've seen in the markets over the last 3 to 5 years, in our opinion, is going to cease to exist. We'll see a very divergent performance where alpha creation becomes even more difficult. So, in that context, here are some strategies we are sort of laying out there that we are replicating in our portfolio management practices as well. And that look pretty contextual and relevant from the current market standpoint. So, number one is that we see value in large caps over mid and small caps, value from the perspective of risk and reward. The safety on a relative basis appears to be larger in large caps. Mid and small caps have taken a beating, which is usually greater than that for large caps in past market cycles, and this can continue this time around as well. Number two is that from a consumption standpoint, we are still biased towards discretionary consumption. We see still pressures at the very bottom of the economy. There is little revival on the rural front. The tax measures primarily apply to the middle class, and hence we are more biased towards urban spending, high value spending, and discretionary plays. Number three, we are taking relative comfort in the sectors of IT and healthcare. These two relatively defense plays are providing a good tactical opportunity from the perspective of demand revival, as well as India's positioning or strengths in these two sectors. Um, the fourth one we're playing is that we're selective on capex. We're not really going very uniformly spread out across capex themes. We're being selective in terms of places that we are playing out. And we're very cognizant of also how the order book growth is looking, execution is looking, and whether valuations are reasonable or not. Number five, in any stock pick, we are looking at earnings support. The corporate results for the last quarter have made it very clear. Anybody who's beaten results has been rewarded. Anybody who's even missed slightly has been punished heavily. We think that the market will increasingly rely on earnings support in order to determine whether any investment is a good idea or not. Earnings support will become extremely critical in determining whether stocks will do well or not. The sixth one is market leadership. We're backing market leaders irrespective of what sectors we're playing. Whether it is larger plays or even very niche plays, where we prefer backing market leaders with strong financials and a proven credibility in the market. And the last, I think, which has been a theme throughout but becomes increasingly important now, is that quality businesses need to be supported. So we're focusing on picking up good quality businesses with strong leadership, robust corporate governance, and very prudent capital allocation. If you follow these seven or any of these seven, I think there is a greater chance, at least in our eyes, that meaningful returns will be made in a relatively tough market compared to the last few years. Um, that's a wrap. Thank you.